Welcome to FinBot Insights. Today, we are going to dissect a fundamental schism, a kind of civil war, that's happening within one of investing's most disciplined philosophies.
And at the heart of it all is this one question. Is a single fund truly the logical endpoint for all passive investors? This simple question creates a deep and frankly surprisingly contentious debate among followers of the Boglehead strategy. It all comes down to whether a single, globally diversified fund is the ultimate expression of their entire philosophy.
Let's remember what the Boglehead philosophy is all about. At its core, it's a strategy built on simplicity, using low-cost, broadly diversified index funds to let your wealth grow. It's about trusting the market's collective wisdom. So you would think this foundation would lead to a straightforward, universally accepted answer. But as we are about to see, the reality is anything but simple. So let's start with one side of this argument. This is the thesis, the case for what you might call global purity. We are going to examine the argument that a single, globally weighted fund, like Vanguard's VT, is the only intellectually consistent choice for someone who considers themselves a true passive investor.
This quote from a discussion on Reddit really captures the purist's position perfectly. The logic here is airtight. If you believe the market is efficient in your own country, it's a flat-out contradiction to then reject that same principle on a global scale.
Following that logic, any deviation from the global market weight becomes an active bet. It is a bet against the market's collective wisdom. So when you choose to overweight the United States, for instance, you are implicitly saying that you believe you know better than the entire global market. That is an active decision, and it runs completely contrary to the core tenets of a passive philosophy.
Okay, so that is the purist argument. But now we have to look at the other side, the antithesis. And there are some really compelling arguments against such a rigid adherence to global market caps. Things like pragmatism and human psychology both present some pretty significant challenges to that purist thesis.
Psychology is an incredibly powerful force in investing. Seeing the massive outperformance of U.S. stocks over the last decade has been tough for global investors. It creates this very potent fear of missing out, and that feeling that I could have had very real money right now often overrides all the long-term data we have about how these performance cycles can last for decades.
And it is not just about psychology. There are some very real pragmatic concerns. First, there's a logical reason for home country bias. You are going to spend your money in your home currency during retirement. Then there is tax efficiency. For investors in the US, holding international funds separately, say VTI and VXUS, can actually give you a foreign tax credit that you just don't get with an all-in-one fund like VT. And on top of that, some investors have real concerns about governance and transparency in certain emerging markets, risks that might not be fully captured by price alone.
Now this is where the debate gets really interesting. We have to bring in the man himself, Jack Bogle, the founder of the philosophy, because his own words, his own recommendations seem to diverge quite a bit from what a modern purist would advocate for.
As one user pointed out, Bogle's own stance favored a heavy U.S. concentration, and that seems to fly directly in the face of the global market cap weighting of a fund like VT, which, by the way, currently holds about 40% in international stocks. That is a huge difference.
But here's the counter-argument, and it is a strong one. This suggests that what really matters are the core principles, broad diversification, low costs, and that we should follow those principles to their logical conclusion. The idea is that the philosophy itself should adapt and evolve, even if that leads us to a different portfolio than the one its own founder recommended.
And it is absolutely crucial that we recognize the context here. The philosophy has evolved beyond its founder, and a big reason for that is that the tools we have also evolved. When Jack Bogle was forming his ideas, global investing was way more costly and way more complex. The arrival of these incredibly cheap, all-in-one global funds like VT is a pretty recent development, and it has fundamentally changed how we can apply his ideas in the real world.
So where does that leave us? How do we find the ultimate synthesis here? Well, the resolution to this conflict is not going to be found in a ticker symbol. It is found in a much deeper understanding of investor behavior and the practical, day-to-day realities of managing a portfolio.
This next comment really drives the point home. One user shared that their complex portfolio netted only 0.02% higher than just holding VT. This anecdote is a powerful illustration of just how hard it is to try and improve on the global market average. Sometimes even a very sophisticated approach can barely justify its own complexity.
The takeaway here is pretty stark. It is incredibly hard to beat VT. The evidence, both anecdotal and academic, is quite clear. Attempting to get meaningful, consistent outperformance by making strategic bets or tilts is an exceptionally difficult game to play. And for most people,
it's a futile endeavor.
But here's the other side of that coin. It is even harder to stick with a strategy that you do not fully believe in. And this really is the central truth of this entire debate. You can have the most intellectually perfect, theoretically sound portfolio on paper, but it is completely worthless if you abandon it at the first sign of trouble. Conviction, therefore, becomes the single most critical component of any long-term plan.
Which brings us to the ultimate question every single passive investor has to answer for themselves. Is your portfolio built on intellectual purity, or is it built on behavioral resilience? Because the better portfolio is not necessarily the one that is most perfect in theory. It is the one that ensures you will actually stay the course for the decades it takes to build wealth.
If this analysis provided you with some value, please do click like and subscribe to FinBot Insights for more content just like this. Your engagement truly helps us dissect more of these important topics for the retail investment community.
And finally, a crucial reminder, this explainer is for informational purposes only. It is not financial advice. Do not trust social media influencers, and that includes this channel, for your investment decisions. You should always conduct your own thorough research and consult with a qualified financial professional before making any choices with your money.